That's what I think. We can speculate hyper-Bitcoinization world where everybody's a Bitcoin treasury company. What does that mean? But that's not in the next decade. And so I don't think it's all that constructive to speculate, because the difference between you being 10,000x more than what you are right now is what you do between now and the next decade, right? And if you tell me what the perfect thing to do is hypothetically 25 years out, well, like, you know, in the long run, we're all dead.
Hey guys, welcome to Everyday Finance. The prediction made by Michael Saylor is that Bitcoin will continue to appreciate by almost 30% on an annual basis over the next 20 years, thereby establishing its position as the new foundation of global capital. Just as oil was the driving force behind the empires of the previous century, Bitcoin is propelling a digital financial revolution in which scarcity, rather than inflation, is the primary driver of value. The distinction between assets that are depreciating and capital that is appreciating is becoming increasingly difficult to ignore as more and more organizations, corporations, and even governments adopt it. Bitcoin, in contrast to fiat currencies, which can be printed, or real estate, which is burdened by costs. It's a product of pure scarcity and demand, and it represents a network that cannot be replicated or inflated. Saylor believes that this is not merely a passing trend, but rather the beginning of a new financial system. This new order is one in which the production of wealth is defined by digital scarcity, and Bitcoin is at the forefront of a digital gold rush that will last for 10 years. From 2025 to 2035,
I guess the observation I make is there's a lot of mortgage-backed credit. You know, we securitized real estate. Think about how big that got. There's a lot of corporate credit. We're securitizing cash flows of corporations. There's a lot of fiat credit. We're securitizing the ability of a company to print more currency and to win their wars, right? And now this, I see, is the industry that creates the digital credit. And everybody in the room is at the beginning, year one of the creation of digital credit. And you can go out there and brag, the most successful corporate bonds in the last 5 years are digital bonds. The most successful convertible bonds are digital bonds. The most successful preferred instruments are digital, right? When you put Bitcoin, when you put a collateral asset appreciating at 50% a year and even 30%, even if it's 20%, the truth is, if Bitcoin only appreciated at the rate of the S&P, every single credit instrument built on top of it would outperform every other credit instrument, because every other credit instrument I just named underperforms the collateral underperforms the S&P. So we're on the verge of the creation of a digital credit market that right now it looks like 20, 30 billion a year. By the way, I'm going to throw that, that's a throwaway. It's 30 billion a year and no one's noticed it exists yet. There's 30 billion a year, and the Wall Street Journal and the New York Times and Forbes, they haven't noticed it exists yet. But we're about to go to 50 billion and 100 billion and 200 billion. And so think about $1 trillion of credit, and when it's $1 trillion of credit, it's not 1% of the credit in the world, and people still don't notice it exists. And so the real opportunity for all these companies is to issue billions, then tens of billions, then hundreds of billions of digital credit. And the reason that your equity is going to go to the moon is because the equity is going to be valued based upon the spread between the credit you're selling, right, and the underlying asset you're buying. And you'll be able to capture that with massive amount of leverage. The more credit you issue, the faster the credit you issue, and the better the credit terms, the more valuable the equity is going to get. Go look. How did you value Amazon the first year after it went public? How did you value, Facebook the first year after they went public, the stock crashed. It actually, it traded at 40% of the IPO price or something. So I think we're so early in the first year. It's very, very difficult. You got to look at all these companies, and at the end of the day, the management teams, they have the world to create. And if Metaplanet can go from a $5 million hotel company to a $5 billion entity in 12 months, and they have yet to issue their first serious credit instrument. It's like, yeah, I think Metaplanet will be the most valuable hotel company in the world. I think they'll also be the most valuable company in Japan. And every day I get up and I'm like, crap, I have to go to work because the Metaplanet people are going to outrun me if I don't. You know? Because I'm sure Simon and Dylan are cooking up something. And I'm like, oh, jeez. Okay. So, but that story could be told in 100 markets. And within one market, when you just go to the US, you're like, okay, well, who's going to own insurance? Who's going to actually partner up with the first bank to offer the 8% bank treasury account? You know, there's so many, at the end of the day, everybody's got limited bandwidth, and there's so many things to be done. We're talking about rebuilding a $300 trillion market, and if we wanted to swap out 10% of it, that's $30 trillion of stuff that has to be done. That's room for $30 trillion companies, right? I kind of expect that Bitcoin will outperform the S&P forever because the S&P is always going to be loaded down with real-world assets and entropic conditions. The companies are going to be currency derivatives, and they're going to have real-world assets that depreciate, and there are going to be political issues, and there's going to be chaos and war and expropriation and tariff and taxes and all of those things. But in theory, if the majority of the index was made up of, if the S&P 500 was made up of 500 Bitcoin treasury companies, and they were all well run, and if the politicians didn't expropriate the assets of the companies, then in theory the S&P is a very interesting index. But I don't think we're getting there anytime in the next 30 years. I think what will happen is Bitcoin companies will creep into the index, and as they creep into the index, they will improve the performance of the S&P, and the S&P will start to creep up. Our client will be improved while Bitcoin will grow, mature, and it'll decelerate based upon the fact that it gets integrated into all other aspects of the economy. And that's what I think. We can speculate hyper-Bitcoinization world where everybody's a Bitcoin treasury company. What does that mean? But that's not in the next decade. And so I don't think it's all that constructive to speculate, because the difference between you being 10,000x more than what you are right now is what you do between now and the next decade, right? And if you tell me what the perfect thing to do is hypothetically 25 years out, well, like, you know, in the long run, we're all dead.
The point that Michael Saylor is trying to convey is crystal clear. Volatility does not indicate weakness. Rather, it represents the process by which Bitcoin strengthens. The foundation for the subsequent period of expansion is strengthened. With each wave of selling and consolidation that occurs before it, because of the increased liquidity and stability that institutions are bringing to the market, Bitcoin has experienced a doubling in value within a year, which is a reflection of its durability and rising maturity, in what some people consider to be a greedy pursuit of wealth. Others see it as an opportunity to enter a financial system that is limited and difficult to manage. Saylor contends that investors' preoccupation with short-term returns fails to take into account the wider picture, which is that true value is not found in rewards, but rather in permanency. In the same way that gold, land, and significant cultural accomplishments have persisted through the ages, Bitcoin today reflects the same idea that has persisted because it is in digital form. In countries where currencies are collapsing or inflation is rampant, it offers a safe haven for the preservation of wealth, which is a hint that it is evolving into the foundation of a new global monetary order.
Yeah, so I think credit is the most fascinating thing, and it's something that I in my life never really paid much attention into until I got into the Bitcoin world. But I mean, I borrowed money. Obviously, I know consumer credit, I know credit cards, I've done leasing, I've done bank loans, I've done senior financing, not quite a junk bond, and I've done convertible bonds, and you know, I've done a quasi-margin loan from a bank, lived to tell about it. I've never done like a 40x levered loan from Binance or Hyperliquid or whatever, where you crank it up and, you know, to 20x or 30x or 40x. I advise against that. Sam Bankman-Fried actually called me once and he pitched me on that. He was like, you know, you should put your Bitcoin at FTX and we can give you margin credit. I actually got pitched by the Three Arrows guys too. I also got pitched by Genesis. I also got pitched by Celsius. I also got pitched by BlockFi. I think I got pitched by just about everyone that went bankrupt during the crypto winter.
Well, you saw it. You didn't do it, so.
Yeah, so I normally say yes enthusiastically in public, but in private I say no a bunch. But coming back to credit, you know, the interesting thing to me is I think theoretically the best kind of digital credit, if we're just inventing the world anew from a blank sheet of paper, is a liquid, publicly traded preferred stock. And a preferred stock can look like a bond, and it can look like an equity. Like if you take one extreme, like STRD, it's a non-cumulative preferred, and that means that, you know, you're paying a dividend. Right now the dividend we pay is like 12.7% or something. You're paying a dividend, but it's non-cumulative, which means that you never pay the principal back. So it's like 1,000 a year, it's forever. You never pay the principal back. You pay 12% dividend yield, and you pay that forever to someone that buys it. But if you ever were in a credit crisis or a credit crunch, you can suspend the dividend without prejudice, without penalty. Now the company would have the option to not suspend it, or the company could suspend it and say, well, we're going to pay you back anyway. If we put out a press release saying we're suspending it this quarter, but we intend to make up for it next year, the preferred stock would fall. And if we put out a press release saying we're suspending the dividend, we'll probably never pay you back, it would fall a lot, right? And then if we didn't actually reinstate the dividend for 2 or 3 years, it would be tanked, you know, start to look like total distressed third world debt. But what you've really got there is equity. Like you're like, why would I buy that? You're really buying like an equity that pays 12.7% dividend. And if you ever think about buying equity, you know, you buy the equity in the company that pays the dividend, and the company can suspend the dividend, and they don't have an obligation. And a lot of people buy, you know, Verizon and AT&T, and you know, there's a lot of dividend-bearing equities in the world. So you can do that, but the difference is, of course, you're giving someone some precision about what it is. And when I think about that, I think, I just created an equity that's a perpetual swap where I'm giving you the first 12.7% of the Bitcoin return forever, and then I'm taking back the rest for my common stock shareholders, and I'm giving you a liquidation preference, and I'm giving you some more certainty, and I'm giving you a commitment of the company that we're going to do it. So that's one extreme credit instrument. The other extreme, you know, would be you have a preferred, and you basically say it pays this much, it's cumulative, there are penalties, and you have a put right. You know, there's a call, there's a put in 3 years or whatever, you can put it back to the company, and that starts to look like debt. You know, and if you, in the extreme, you can make it look like perfect, like super senior debt. And I think the beauty of that preferred instrument is it's a programmable container, and you can program that container with any amount of delta. You can put 60 delta, 80 delta, 10 delta. You can put any conversion rate. You can put any duration. You can put any credit duration. You can put any yield duration. You can put any representation. You can put any penalties and rates you want. You know, you can stack them all up, and you can put it in any currency basis you want. You could even plug in all sorts of floaters and indexes. You can index it to SOFR and index it to the Japanese bank rate. So you can do pretty much anything, and that's the beauty of those instruments. If you're a public treasury company, for the most part, you can craft, you know, a perfect piece of credit, and then you could sell it 144A, or you could take it public. But But my view with credit is the real innovations are you create a credit instrument that you can sell to the public as easily as they can buy an ETF. And then the next innovation is, can you get it on the NASDAQ? And then can you get it on other foreign exchanges? How many exchanges can you get it on? And then the next innovation is, can you put a shelf registration on it? And after you've done all that, then the question is, what's the collateral backing it, and how do you want to run the rest of the company? And I think it's you can lay out the perfect ideal strategy, but coming back to the impediments, and these are, I'm going to ask you guys about these, right? The impediments to doing that are, if you do it unrated, you've got to go market that instrument to public investors and retail investors that will buy an unrated instrument. So you have a marketing lift. If you want to sell that to the insurance industry, I think there's organizations like Mercer and the like that are creating model portfolios, and they're gatekeepers. And then you have the credit rating agencies like Moody's and Fitch and S&P, and they're also gatekeepers.
The vision that Michael Saylor has for Bitcoin goes well beyond perceiving it as merely a store of value. Rather, he sees it as the basis for a full reinvention of credit itself. He contends that traditional financial instruments such as mortgages, corporate bonds, and government debt ensnare investors in positions that give poor yields and significant levels of risk. But Bitcoin provides investors with the opportunity for faster growth and stronger collateral potential. From this foundation, Saylor anticipates a new generation of credit markets, some of which will be structured similarly to bonds and will have predictable returns, while others will be built similarly to equities and will have a higher level of risk and a bigger potential for upside. He even envisions money market instruments that are backed by Bitcoin that are capable of producing consistent monthly yields, which is something that traditional finance has never been able to accomplish. His objective, however, is not merely to innovate in the field of financial engineering. Rather, it is to alter. Assuming that credit and equity systems are anchored in the transparent and incorruptible network of Bitcoin, Saylor envisions a global economy that is more equitable and resilient, one that reduces the effects of manipulation, reduces inequality, and rebuilds confidence. He believes that the next 10 years will not only be a period of digital gold rush, but also a period of social and financial reset that will be founded on digital sound income.